Hey everybody, it's Erik, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Village Global's Venture Stories Web3 edition. I'm here today joined by a returning guest, Haseeb Qureshi. Haseeb is a partner at Dragonfly Capital. Haseeb, welcome back to the podcast.
Thanks for having me, Erik.
So Haseeb, a lot has happened since we last spoke, and I want to kind of chronicle a little bit what's happened. So right now we are in a crypto winter. This is not our first time in a crypto winter. Why don't you contextualize a little bit? How do you contextualize this crypto bear market with previous crypto bear markets, and how should we think about what that means for going forward?
Yeah. So I imagine most people are familiar with what happened in crypto from 2017 to 2018. That bear market really was precipitated by the popping of the ICO bubble. So you remember late 2017, ICOs, which was this like decentralized fundraising mechanism, went really crazy. There were a ton of tokens that were valued extremely speculatively. And then there was a moment where people just kind of lost confidence. People felt like the top was too frothy. And then slowly everything started unraveling. Every single token dumped. A bunch of things went to as close to zero as anything in crypto gets. Obviously, nothing in crypto ever actually hits zero, but gets close enough that you can write off your portfolio. And then the whole thing, by Bitcoin went, 20K to I think 3,000 at the bottom, and Ethereum went from 1,200 to double digits. So it was a pretty brutal ride. Now, in the same fashion in this cycle, we've seen, compared to where Bitcoin was just 7-8 months ago, Bitcoin was at north of 60K. Now it's just below 30K. Ethereum was at 4,000 something. Now it's at it's below 2,000. It's like 1,800-ish. So are we seeing a repeat of the same story? And the answer, as always, is yes and no. So the first is what's similar. What's similar is that, okay, there's been, some shaking of confidence. We saw the collapse of Luna/UST, which was this big decentralized algorithmic stablecoin that spooked a lot of people last month, and it's caused a lot of hemming and hawing in the industry. So there have been massive failures and things that went down to zero. But that's actually a minority of what's happened in crypto. Actually, it's a pretty small part. Most of the things that are in the top 20, top 30 in crypto are actually working. They're fine. They're totally robust. The fundamentals look okay. The real thing that's happening in crypto is that this drawdown has actually not been endogenous the way that the last drawdown was. This has actually been completely driven by macro. So what you've seen is that historically, from basically if you take crypto from inception up till about late 2020, the correlation between crypto and the NASDAQ was about 0.1, meaning that there was very little correlation. For the most part, crypto did its thing, the NASDAQ did its thing, and never the twain shed meat. The thing that changed in the year 2020 that was the beginning of the institutional adoption of crypto. And for a long time in crypto, we've been talking about the institutions are coming, hoping that someday institutions will be here. Well, they're here now. And now the institutions are here. What that does is it means that you now have common ownership. The same people who own the S&P 500 and own the NASDAQ and own all these tech stocks also own crypto. And when their risk models tell them, hey, it's time to cut risk, it's time to go, buy more treasuries, crypto is in the same bucket as all the other risky stuff. And so it ends up moving in lockstep. So this is one of the consequences of common ownership is actually the correlation with other asset classes goes up. But the second thing about it is that because crypto has been moving up and down in this risk portfolio, but crypto is tied to macro. And a lot of people are like, why is this happening? Why is crypto tied to macro? Isn't it weird? Shouldn't crypto be uncorrelated from macro? And the answer, I think pretty resoundingly, is no, of course not. Crypto is very fundamentally tied to interest rates for fairly straightforward reasons. So first of all, crypto's only existed in a low interest rate environment, right? It was literally, Bitcoin was created after the great financial crisis. And ever since then, real rates have been very deeply negative all over the world, but particularly in the US. We're now moving into a world where the expectations that real rates are going to increase. We'll see whether or not they're positive, but at least they're increasing or getting near to zero. In that world, a few things change. So one is that you're less starved for yield. Right. When the risk-free rate goes up, it means that sources of weird yield or weirder things you can do to generate yield are no longer quite as necessary. And that's a lot of what DeFi was about. DeFi, a lot of its early product market fit was people being able to generate and attract yield in a world that was starved for yield. But when everyone's a little bit more fed on yield, then the marginal demand for DeFi is going to go down, right? So to the extent that a lot of crypto is about the story of where you can find yield in a yield-starved environment, that becomes less attractive on a relative basis in a world of high interest rates. But the second and most obvious point about why interest rates affect crypto is that crypto is a bet on the future. And anytime you're betting on the future, the discount rate on the future and the rate at which you should care about present cash flows versus future cash flows matters, right? So Bitcoin, digital gold, but it's not digital gold today. Everyone kind of understands that, right? It's a speculative asset today. Eventually, it'll be digital gold, and that's the thing that we're all betting on, is that eventually become that. But the rate at which it becomes digital gold, how long that you think that'll take, affects the discount rate that you should be applying to Bitcoin. And the same thing is true for everything in layer ones and Avalanche and Solana and blah blah blah. All these things are bets on the far future, right? We believe that someday these things will get adopted, and they'll be used, and there'll be tens, hundreds of millions of users on these things, but they're not here today, and that's why interest rates matter and they affect crypto. And so, in some sense, I think there's actually reasons to be sanguine, because crypto actually drew down less than some of the other things that were comparable growth stocks, right? If you look at sort of pre-revenue, far future bets, a lot of them are down 70, 80%, whereas Ethereum is down maybe 60% from the high. And that might not sound like a big deal. Okay, something else is, what is it? Netflix is down like 80%, Ethereum is down 60%. Is that really that big of a difference? Well, it's a difference of 2x actually, because being down 60% and being down 80% means that you have twice as much left as you might otherwise have. And a lot, in the throes of a bull market, of a bear market, it's sometimes hard to appreciate the enormity of the difference between something that's down 80% and something that's down 60%. But I think if you take a holistic view, crypto fundamentals actually look okay. People are still using this stuff. They're still paying fees. OpenSea is still getting volume. People are still trading NFTs. They're still playing GameFi. All this stuff is still happening. There's still entrepreneurs who are building. There's still a lot of innovation taking place. But it's the price level has been reset because of the different macro environment, and that's why I think it's different.
Yeah, that's a great synopsis. So a few follow-up questions. One is, you're still excited about Bitcoin's potential to be a risk off, a hedge against inflation. What needs to be true for that to happen?
A lot of time. I mean, the reality is Bitcoin gets less volatile every single year, right? You just do the math. You just look at the chart. It gets volatile every year, and it's going to get more and more boring as more and more people discover it. And whoever's going to buy it is going to buy it, and whoever's not going to buy it never buys it. The problem with Bitcoin, the reason why it's so unstable, is that there are still people who haven't decided yet whether or not they want Bitcoin. But eventually, we'll all decide. Eventually, Bitcoin will be 30 years old. It'll be some boring old asset that you associate with boomers and your parents and whatever. And it stopped feeling so fantastical or so unique or so interesting. And that's when the volatility of Bitcoin will go down, and we'll figure out the role that it plays as a commodity in the broader picture of commodities. Right now, the idea of Bitcoin as an inflation hedge today is laughable. Right? It's obviously wrong. Bitcoin is not an inflation hedge. It's hardly correlated to inflation. Some people say that, Bitcoin will go up when there's inflation. Some people, Bitcoin will go down when there's inflation. No, there's no connection. Just draw the line out. There's no connection between Bitcoin and inflation. The idea is that maybe someday there will be, to the extent that people use gold as a flight to safety asset. But the reality is even gold isn't a great inflation hedge. So this is another kind of somewhat BS narrative that tends to circulate a lot in the crypto economy. The goal is not to be a hedge. A hedge means that you're anti-correlated, right? It means that when that goes up, you go down. The goal for Bitcoin and what it's been historically is uncorrelated. And that is, I think, the role that it's probably going to end up playing in a lot of economies, that it's going to be uncorrelated with a lot of these other assets, not anti-correlated. I mean, we'll see. It's obviously hard to draw the line out that far, but the honest answer is that you just wait. Bitcoin will eventually get there.
Yeah, that's encouraging. And then, so for people who are looking for, investment opportunities in terms of like, what's the next narrative or what's the next thing that's going to kind of take off in the next 6 months, is it more exogenous, as you said, like, hey, just wait for the market to get better, or like sit in cash in the meantime, or like, how do you think about that?
No, that's a fair question. I would definitely never say that, you just wait for macro to get better and then you'll make money. That may be true for Bitcoin. It may be true for some of the other things like Ethereum. But when it comes to betting on the next big trend, I don't think is going to be macro driven. It's going to be adoption driven. So where is that adoption going to come from? In an environment of positive real rates, right, where interest rates are going up, it changes a lot about what you should expect from consumer behavior. Like I said, crypto's only existed in a world of low interest rates. So when you get to high interest rates, you should expect weird things to happen. You should expect things to change. So one of those things that I think we're already seeing is we're seeing less demand for speculation. right? Okay, now why are you seeing that? In a world of deeply negative real rates, what that means, like practically speaking, it means that you work your job, you come home, you go look at your 401k, and it's worth less than it was yesterday, right? It means that your wealth is actively being eroded as you sit there and just live your life. And so that means that, like, hey, you come home and your incentive is, to go bet on a meme stock, or to go join a DAO, or to go buy some NFTs, or to go, liquidity mine something, right? That there's an incentive for speculation, because otherwise you have no shot at really growing your wealth. Now, in a world of positive real rates, then your incentive becomes, okay, work your job, come home, watch Netflix, and just have Wealthfront take care of your wealth. Like it'll just grow over time by itself. And that world leads to very different consumer behavior, right? We're seeing that. We're seeing it across the board. So whether it be in, Robinhood participation going down, there are fewer retail traders trading this stuff. Volumes have gone down. We're seeing the meme stock phenomenon start to go away, right? There are no new meme stocks in the last year. Where do they all go? I mean, GameStop and AMC are still there. They're still weird, but there are no new ones. And you see the same thing in crypto side, right? For Q1 earnings and for Coinbase, they had a big earnings miss. And a large part of the reason why it spooked Wall Street was because Coinbase for the first time had a significant drop in retail participation. And it was the first time ever that there were more institutions trading on Coinbase than there were retail, which is new. We've never been an institution-driven market before, but here we are. Crypto is now institution-driven. So what that means is that things that are more speculative are not going to do as well. Things that are more financial in nature are not going to do as well. And the things that will likely do better are things that people will still do in a world where there's less speculation and also potentially, less household savings. So what will people do? Let's say we go into a recession. What are people going to still do in a recession? Well, they might not yield farm, but they'll probably still play games. They'll probably still own NFTs, and they'll still, have profile pictures, and they'll still, bullshit each other on Twitter and, whatever. They'll still be parts of these communities. So the things that look more like consumption are the activities that you should expect will continue to grow and do well in an environment like we're probably seeing over the next 6 to 18 months. So if I had to guess, I would say that things like crypto gaming, NFTs, and the infrastructure that supports them are likely going to be the place where we see most of the growth in crypto over the next period. But it also depends on your view of macro, right? So if you think that we're not going to stay in an environment of higher real rates, and you think that rates are eventually going down once the Fed gets inflation under control, then you might have a different view. Then your view might be like, look, I think all this stuff is coming back. The music's going to start playing again as soon as inflation gets tamped down and rates, the Fed pumps the brakes on rates. So it depends on what you think the macro picture is going to look like. But the short answer is that I think things that people use are the things that are going to grow.
Yeah. So opportunity for consumer.
Exactly.
Finally, crypto consumer. Let's talk about Ethereum. There's been over the years. I remember a couple of years ago, Fred Wilson said Ethereum needs a CEO. People have been complaining about kind of Ethereum's shipping cadence. This, ETH2 is in fact not ETH2. This sort of stuff. There was someone who wrote something recently about how Ethereum is in a hard place where they're not digital gold and they're not as effective as Solana at going to be able to scale or speed. And so they're in this kind of messy middle where they're neither nor. I think you disagree with that. Why don't you unpack your take on Ethereum?
So it's an age-old question, right? Is boring, stable governance better than fast, effective governance? And that's the story. Ethereum is boring, stable governance. So it doesn't really change a lot. There's no drama. There's no big horrible thing that you're worried about. But you're also look, when is this shit going to get better? Whereas, contrast that with Solana. Solana is a perfect example of, move fast, break things, and things break a lot. And that creates another set of constraints and another set of challenges that Solana, for example, has to deal with. The reality is you need both. But once something becomes big and really important, there is a premium on having the governance of that thing be kind of boring and stable. So, there's a lot of complaints about gridlock in the US and Congress. But if you compare that to places that are constantly changing their laws and constantly, having shifts in the balance of power, you might prefer it. You might prefer a world where, you don't need to know that much about what's happening on Capitol Hill because not much is happening. That can actually be good because it gives entrepreneurs, it gives builders, it gives people a stable foundation on which to, rest their assumptions about what they can do and what they can build. So I'd say for the most part. Now, I don't mean to say that Ethereum governance is ideal or even close to it, or that it's good. I think there are a lot of things that obviously could be improved about Ethereum governance and Ethereum technology itself. But the reality is Ethereum, I mean, here's the other thing that people, I think, don't appreciate enough about Ethereum. So Ethereum is now about 7 years old, maybe slightly older than 7 years. Bitcoin is, 13 years old. So right now, Bitcoin is about twice as old as Ethereum. In another 7 years, Bitcoin will be 20 years old, and Ethereum will be 14 years old. And the spread will get smaller and smaller, right? It will stop looking so much like Bitcoin is a really old one and Ethereum is the new one. It'll start looking more and more like these are both really old, and they're both really stable, and they've both been around forever, and they're both like things that you can basically trust will never go away. And I think that's honestly a lot of the value of Ethereum is the fact that it was first, the fact that it's been there for a long time, the fact that the community can rely on it, and it's not going anywhere. I think a lot of people believe that Ethereum is about this, proof of stake, sharding, blah, blah, blah story. And I think that's actually a misapprehension of what makes Ethereum, what makes Ethereum so powerful and so important in the crypto pantheon. I think the transition to proof of stake, which is slated to happen this year, is really important. And it is something that I actually have high confidence will happen. But Ethereum moving to a world of higher scalability, so to be clear, when Ethereum launches Ethereum 2.0, it doesn't get any more scalable. The fees don't go down. It doesn't get faster. None of those things happen. All that happens is that the proof of work stuff goes away. So there's no more mining. There's no more energy runoff. There's no more, negative externalities around carbon consumption. Ethereum goes green, basically, which is great. And the monetary policy changes to reflect that. But in a way, it's more about the positive externalities in the world and the narrative shift for Ethereum than it is about any improvement in performance. But I think that's okay. I think the reality is that we live now in a multi-chain world. There's not just one chain, and it doesn't look like there will be. The best analogy I can give for it is that Ethereum is like Manhattan. It's the most happening place in crypto. It's really expensive. It's really old. The governance is kind of just stuck in time. Like you can never build anything new. It's it's super painful, but it's also super cool. The biggest DeFi protocols and banks and whatever, they're all there the same way as the biggest financial institutions are all in New York. If you're a new up and comer, like maybe you're priced out, you can't rent an apartment there, and you feel like everyone else already got rich and you're too late to the party. But culturally, it's the most important place. It's a place you couldn't do without. But if you want to grow a country, you can't just do it in one city. It doesn't work. Right. And you can't just say, like, look, we're going to crack open Manhattan and we're going to extend it and we're going to create, blah, 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 because everyone wants to live here. It's like, no. You let Manhattan be Manhattan. But you need other cities to complement it, right? You need a Boston, you need a Jersey City, you need an LA, you need a Chicago. And that's what these other L1s are. They kind of fill in the gaps of saying, you know what, we're going to make different trade-offs. We're going to be governed differently. We're going to have a different culture. We're going to make ourselves appealing to different kinds of industries or different kinds of applications. And that's what we're seeing, whether it be Solana or Avalanche or Near Protocol. Each of these layer ones has a different identity, a different culture. They target a different kind of application. They have a different set of trade-offs between decentralization, throughput, speed of iteration, et cetera. And I think that is likely to persist. I think we're going to see that be the way that blockchains look for a long time. Eventually, to the consumer, it may end up looking opaque because as a consumer, like you don't necessarily care, for example, what was sourced in the supply chain for your shoes. All you know is that you have cheap shoes. You don't need to know that, like, hey, this thing was made in Boise and this thing came from China and this thing came from Malaysia. All you know is like, hey, these shoes are great. And I suspect that's the experience of most consumers when they interact with crypto. But for people who are really deep in crypto and who are interacting on a day-to-day basis with some of the applications and some of the games and the other parts of the ecosystem, these things will live on one chain or another as defined by the trade-offs that make sense for that particular application.
So are you suggesting that maybe there won't be, kind of a power law, one or two, platforms that kind of take most of market share with some fragmentation outside of that, and that it'll truly be, really spread out in the way that cities are, but maybe nations aren't in terms of power or something. What's your take on the concentration?
Well, I'd say the opposite. I'd say actually that cities do obey a power law, right? If you look at New York, it's by far the largest city in the US. And then LA is like maybe half the size of New York. And then Chicago is like 2/3 the size of that. And then what's after that? Houston or something, which is like smaller than that. And then it really, out of the top 10, it really falls off, right? There's really not a lot of major cities outside the top 10. Same thing as nations, right? Nations have the exact same power law, where US is like, twice as big GDP as China, and then it kind of falls off after that. You see this kind of law. It's actually Zipf's law is the description of this kind of this sort of distribution. It's very, very common. And I think you already see, I'm not even making a theory. Like this is, if you just look at the market caps of crypto, that's what it looks like, right? Like Ethereum is like, 3 times the size of a BNB chain. And then there's Solana, which is like a third of that. And then there's, the third of that is half of that. And it looks a lot like if you just chart the market caps of cryptocurrencies or layer ones next to the next to the population size of cities, you get a very similar distribution. And so this is not so much a theoretical description as a descriptive description of what's actually the case today. And I just think that's not going to change. I think that what you're going to see is that we often like to describe layer ones as networks, which is a deceiving metaphor. Because when you think of a network, you think of something like Facebook or something like the internet, in which case there is no constraint on how big Facebook can get. There's no constraint on how big the internet can get. But blockchains are actually physically constrained. They're physically constrained because they cannot be arbitrarily big. If they're arbitrarily big, they cannot be decentralized anymore. So you have to have some binding constraint on how big a block can be. And it is still a network, but it's a network that's physically constrained, which is exactly like a city. A city is a network that is physically constrained. Right? You can only make a city so big. Once it gets too big, it splits in, there's like Dallas and Fort Worth, where they're big, but they're two cities that are like just close to each other. And I think the same thing is true in blockchains. And that's why we're going to see similar dynamics emerge as they end up growing and evolving.
Yeah. It's really interesting. Like if someone made the following predictions, basically that Ethereum has a better chance of winning digital gold than it does kind of the, smart contract platform everyone builds on, because, it's going to be more ESG favorable and companies are really going to care about that. And Bitcoin is increasingly seen as this kind of like anarchic, libertarian, almost right-wing kind of, crazy community. And corporations want to be more in tune with kind of Ethereum values, then maybe they'll, and to the extent that we convince all corporations to hold some percentage of, or a small percentage in crypto more broadly, maybe they choose Ethereum. So that's sort of one prediction. And the other prediction is because Solana isn't, focused, or some of these other platforms are not focused on being, World War III proof, and they're not, they're just focused on scalability, relentlessly. Maybe they'll be more likely to, be the platform that millions of people are building on and using. Would you disagree with any of those predictions, or think that something else is more likely, or what's your take?
I find that plausible. I don't know how likely it is that those things are true, but I find it plausible. I don't think it matters so much to be World War III resistant. I think this is this is something that certainly is core to the Ethereum set of values. And I think it's important that Ethereum try to play that role. But is it important for other blockchains to also be quote unquote World War III resistant? And I guess part of the reason why I'm somewhat skeptical of this is that, this idea that blockchains need to be resistant to nation state level of attacks. This is a very old idea, right? It arrives in, very, very old blog posts or forum posts in Bitcoin Talk, like back in the early, like 2010, 2011 is when people were first talking about this idea. And we've never let go of this, right? You read academic papers that describe how blockchains work. It's like, okay, here's how we do against a nation state level of attack. The reality, of course, is that you want to make sure that your threat model is actually being updated in real time as your understanding of the world is improving. And our understanding of the world has changed such that we realize that's not what nation states do. Blockchains have been around for over a decade now, and nation states aren't attacking it. The way that nation states attack blockchains is not by doing, buying a bunch of hash rate and doing a bunch of crazy shenanigans on chain. They do what China did, which is they just ban it and they throw people in jail, right? That's the nation state level attack. So the real thing that you have to worry about is you have to worry about robustness. You have to worry about collusion among the actors who are close to the network, blah, blah, blah. I think these are the things that you have to really think about. But you also need to think about what is the likelihood that nation states want to throw the people behind this thing in jail. And maybe that's actually an even more important part of the security model of a blockchain than the question of, can this thing survive a central bank buying up hash rate? So I think not everybody agrees with this mode of analysis, but I think what it tells you is that it's something, actually, to your point, it's very important to adopt the right values, because adopting the right values, I think, has a very big impact on how lawmakers, regulators, and nation states are going to perceive you. And when it comes to real world security and real world robustness, Ethereum is actually much, much, much safer than a lot of other things in the space, not because of any properties of decentralization or, true kind of on-chain security, but just because Ethereum has a great brand. Yeah. And having a great brand actually matters a lot. with respect to how you're going to be perceived by governments, by legislators, and by regulators.
Totally. You had this blog post, I feel like a couple of years ago, where you said something like, if Bitcoin is supposed to be seen as a threat to governments, why aren't they more scared? Or I don't want to botch your argument. Why don't you unpack your argument and what you think we've learned since, or if you
yes. So the original blog post, this is like 2018, I think I wrote this blog post. The blog post, I'm trying to recall it. Basically, the core premise of the argument is, why haven't governments already banned crypto? And specifically Bitcoin. Why haven't governments already banned Bitcoin? It seems like from first principles, you should assume, okay, this is a non-sovereign form of money that anybody can use, anybody can transfer to anybody else. It kind of violates every single assumption about how money works that most regulators, financial regulators, have assumed. It can be used for money laundering, be used by drugs. It can be used, obviously it's not really used for any of those things, but of course, in theory, it can. So why isn't it banned? It seems like exactly the kind of thing that governments would want to ban if you took its claim seriously. So there are a few theories that you could advance of why it hasn't already been banned. A bad theory would be that you can't ban it because Bitcoin is so powerful and so wonderful and blah, 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 right? I mean, China's already shown us, no, you can just ban it. It's fine. So what's a good theory of why Bitcoin hasn't been banned? So one theory is that nation states are actually less monolithic and sort of, single-mindedly competent than you might otherwise think. And any attempt to reify the nation state as a single actor that is keeping its own incentives in mind is just a bad theory. That's one story you could tell. It's just not, it's the wrong way to think about it. A second theory you could advance is that the reason why nation states are not banning crypto is that Bitcoin is too small, it just doesn't matter. That's actually not a bad theory. I think that's a reasonable one because Bitcoin on absolute scale is not that big, at least not for any particular country, right? So if you're the US, you have a gigantic economy. Bitcoin, okay, sure, nominally it's 500, 600 billion market cap for Bitcoin, but how much of that is actually moving through the US economy? A pretty small portion. Most of it is just sitting around doing nothing. So it's like one big stock, right? How much are you worried about one one Facebook-sized company? I mean, maybe Facebook's a bad example, just because it's so triggering as a company. But I don't know, one Berkshire Hathaway-sized company. How big is that relative to we have to regulate this one thing? Maybe it's just not that big. A third theory is that actually maybe Bitcoin is not that scary. Maybe the idea that Bitcoin is this big bad wolf that all these governments are letting in like a sleeper cell, and they don't understand how they're they're risking their own lives by letting this thing in the front door. Maybe that's just wrong, and maybe actually that governments see Bitcoin as pretty harmless. They see it as anodyne. Actually, it doesn't really impair any of their policy goals or any of the things they actually care about with respect to financial regulation. And I suspect that this is actually closest to the real answer, because Bitcoin is not private. Bitcoin is not particularly stable, right? It's not a great financial store of value in that sense. Bitcoin is mostly kind of a financial curiosity. People don't really, I think the best theory why people don't want to regulate is that it doesn't do anything. It's not scary. It's just a thing people can buy. People can buy gold, people can buy silver, they can buy Bitcoin. There are very few governments in the world that are, humming and hawing about people buying gold or silver. Now, there are a few countries that do. India being a good example of it, China being a good example of it. And in fact, these are the countries that have been most inimical to crypto. But most first world countries don't care. You can buy as much gold or as much silver as you want. And I think that's most likely the correct theory for Bitcoin. But what it implies is that may not be true for Ethereum. It may not be true for smart contracts. It may not be true for DeFi. It may not be true for these other things. And in fact, I think that, I wrote this in 2018, back before any of this stuff was big, right? DeFi was small, privacy coins were de minimis, all this stuff really wasn't working yet. And now that it's here, now that we do see many more things that are sort of user and application facing in crypto, I think you can see it for yourself. The attitude has changed. There's a lot more discomfort with things that are happening in DeFi, things that are happening more broadly in crypto outside of Bitcoin, which makes me think that that's probably why it is that governments so far have been largely okay with Bitcoin existing.
Yeah. It'll be interesting to see if they get involved in more of a major way, just what that means for the space. And you gave one example of just brand being really important, very clear values being really important. And everyone's so focused on the tech, but that isn't always how regulators are going to evaluate projects.
Yeah. It's also very important that Ethereum has managed to get the approval of a lot of the intelligentsia. Now, it hasn't done so for everyone, right? The New York Times can't stop writing hit pieces about how proof of work is, scourging the planet or whatever. How NFTs are evil because they cause all these, blah, 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 whatever, right? And I'm sure once Ethereum moves to proof of stake, they will find some other reason to be mad at crypto. And, it's like, you're absolutely right that there is a kind of right-wing element to crypto that's just been branded into people's brains. And I don't think they'll let it go, even if Ethereum moves to proof of stake. So I think there's some of this there, but the reality is that there are a lot of people in high places who perceive Ethereum and crypto broadly as being really interesting and good and innovative. Yeah. And we've seen the embrace of so many companies that are getting into NFTs, things like, all of these Fortune 500 players who've started becoming more ostensibly crypto friendly, Facebook and Instagram adopting NFTs, and Twitter having profile pictures, and, Square and blah, blah, all so on and so forth. All these folks getting into crypto in a big way shows them they're like, hey, this stuff is normal now. It's not scary, and it's okay to endorse it.
Totally. That's great context. Segueing a little bit, we mentioned stable coins. You came on a few years ago with Miles Snyder, and we gave a deep dive into the different models of stable coins, and it was largely theoretical. There were some examples starting to play out, but now we've seen more examples. We've seen some work, some majorly collapse, which you wrote about, Tara, recently. Where do you think we are in the stablecoin experiment? Do you have any inklings as to how it might play out?
Yeah. So stablecoins have always been somewhat fraught. Terra collapsed in May, and Terra was a very large stablecoin. It was about 14 billion in UST that was circulating. Although most of that UST was not actually circulating, most of it was sitting locked in Anchor. But so the actual float was much smaller. But nominally, at least, it was 14 billion that got wiped out. And most of what that's caused is not, a lot of people get concerned within crypto about this idea of systemic risk. It's like, what if there's systemic risk from crypto? What if it, causes a great financial crisis type situation? You get even Janet Yellen speculating about how much contagion effect there might be from crypto. The reality is that, okay, Terra completely collapsed, right? Literally the whole thing went to zero. There was a bank run. The thing, exploded on itself in an extremely dramatic way. Was there contagion from UST? The answer is no. Nothing else in crypto. MakerDAO was fine. Compound was fine. Ethereum was fine. Everything else in crypto was fine, because things in crypto get to make choices for themselves. Compound decided not to list anything from Terra or UST. Almost nobody else used UST for anything if they weren't in the Terra ecosystem, because other people felt like, hey, I don't know if this thing is trustworthy. People chose with their own wallets, so they decided that they didn't want to create reliance on this thing. And so the robustness of crypto notwithstanding, the story from regulators is, okay, this is scary, and it's now time to jump into consumer protection mode. And so anytime that you have a situation where something bad happens, if a girl falls down a well, there's always going to be some, rallying cry of like, oh, we should pass a law for, the girl falling down wells law that prevents girls from going near wells, right? And so there's going to be some very narrowly kind of contrived regulation that's going to say algorithmic stablecoins are illegal or something. I'm sure we're going to see stuff like this. We already just saw in Japan just their legislature passed a bill saying that stablecoins must be redeemable one for one with, some underlying value, which is like, okay, no kidding. I mean, yes, understood. So I do think there's going to be probably punitive stablecoin regulation, or algorithmic stablecoins that we made illegal in some jurisdictions for whatever reason, just because, look, you always want to make sure the last thing that failed doesn't happen again, even though nobody needs to be told, don't do UST again. People understand, don't do UST again. But that's how lawmakers tend to operate. In the longer run, I think the bigger impact is going to be the sense that, like, hey, we need to get this thing under control. I think it's much more likely that we're going to see spillover effects to broader DeFi regulation, and especially to broader stablecoin regulation. I think it's the biggest risk is going to be that we face a world where the OCC basically gets what it wants. Treasury gets what they want. They say, hey, all these stable coins, they're basically unregulated dollars. We need to bring these back under the jurisdiction of banking regulation. These are basically just, unlicensed banks. They require all stablecoin issuers to get bank charters, which of course is extremely difficult. Most stablecoin issuers couldn't do that. And it means that when a user owns a stablecoin, they have to be KYC. They have to, the bank has to perform AML. They have to, issue they have to have some control and some visibility and some surveillance of people who are holding these stablecoins and transacting in them. In which case, these things are just, they're just bank accounts. They're just, bank deposits that are T+0. And in that world, basically the crypto demand for stablecoins completely collapses, because stablecoins are so interesting. They're such a vibrant market because they're global. Everybody in the world denominates their crypto trading in USDT or in USDC, which are the two dominant stablecoins. Doesn't matter whether you're in Asia, whether you're in Singapore, whether you're in Malaysia, whether you're in Japan, whether you're in Korea, everybody denominates their trading against USDT or USDC. And if you remove the ability of people to do this, then that is going to erase a huge part of the crypto trading market. But of course, a lot of the other innovation of stablecoins is that stablecoins don't have to be owned by people. They can be owned by smart contracts. They can be owned by AIs. They can be owned by all these other sorts of phenomena, by multisigs, by DAOs, by all this other stuff that doesn't exist in the concept of banking regulation. And so if we see that, most likely, I think what happens is that if we see punitive stablecoin regulation, we're going to have to move into a world where the dominant stablecoins in crypto become decentralized stablecoins. So whether that be a MakerDAO, whether that be Frax, whether that be one of these other forms of stablecoins, that is going to be the time where we see the huge renaissance of not just innovation, but also demand for stablecoins, if we see that happen. Right now, these guys are waiting in the wings to see what happens with centralized stablecoin regulation. But depending on what happens there, I suspect that we're going to see a lot of really interesting things happen on the decentralized stablecoin side. But for now, it's a radioactive market to be touching. And especially, again, right after the last collapse, nobody wants to be, out there with a loudspeaker talking about how great their decentralized stablecoin is.
That's very good color. I want to go back to your famous blockchains as cities metaphor, and you have a great blog post about this and a great podcast on Bankless about it. But it's, one of the big questions people have about the future is obviously who are the big winners, how multi-chain is it, et cetera. And your analogy of the cities, talk a little bit about that in terms of describing what are the different trade-offs that some of these, we talked about Ethereum and we talked about Bitcoin, obviously, but there's Solana, there's Avalanche, there's Near, there's others. Talk about some of the main ones, what trade-offs, they're making as they relate to different cities and or cities as analogies. And if you have any predictions about ones that you're, more excited about to the extent that you feel comfortable.
Yeah, absolutely. So, I made the analogy of Ethereum being Manhattan, crazy expensive, very slow to move, slow to change, but it's full of culture, it's full of money, it's full of vibrancy, it's a happening place, right? So, but let's say that you want to scale your country past Manhattan, right? Not everybody can live in Manhattan. So where do you go? What do you do? So one option is to build something like a sidechain. A sidechain is, there's something like Axie Infinity has its own sidechain. It's kind of a somewhat centralized chain that sort of lives in the periphery of the main blockchain. So, that's something like maybe Jersey City is kind of like the sidechain to New York. But most of where people go and most of what the real vibrancy of economic activity comes from is from having different cities that have very different cultures from each other and specialize in different things, right? America would not be America if we all lived on the East Coast. It wouldn't be the same place. You need the West Coast, and you need this kind of different generation of thinkers and builders and intellectuals and culture that interact to create the tapestry of what makes America so interesting. So now the second generation of cities that have been built, the most, the one that we just spoke about earlier is Solana. So Solana, I liken to being like LA. Solana is this place where, it's we went all the way west. It's super, high performance, decentralization, I don't know, it's all that highfalutin East Coast stuff. It's all about, getting your 5 minutes of fame, launching your NFT collection. It's super cheap. It's super fast. It's for the people. The weather's great. It's awesome. It's all a bunch of sprawl. It's fine. Just go get your own house, get your mansion. It's no big deal. Nobody has to live in high rises if you live here in LA. And that feeling, obviously it engenders a lot of scorn from the East Coast crowd, the decentralization, maximalist, traditionalists. They're like, oh, this is so centralized, so bullshit. But Solana's just doing its thing. And it's like, man, look, we don't pick on anyone. We don't want, we don't try to fight with anyone. We're just doing our thing. And we just love Solana. Unless you're Kyle from Multicoin, in which case you pick fights. But everyone else, Solana is very friendly. And they're just like, live and let live. It's all cool. So that's Solana. The next one that I characterize is Avalanche. So Avalanche, I liken more to like Chicago. So Avalanche is actually more, it's kind of in the style of New York, right? Avalanche, it copied the EVM, which is the virtual machine behind Ethereum, meaning you can launch programs. You can launch an Ethereum directly onto Avalanche, which you can't do on Solana. Solana is its own whole thing. But, Chicago, it's kind of recognizable to New York, where it's like, it's kind of financy. It's a kind of fast moving city. There's a lot of trading. It's very finance oriented. It's very brusque, but it's a strong place. It's got a strong culture. It's got a very, kind of, the energy is recognizable to New Yorker, the kind of feeling that you have in Chicago. And it's also, it's a little bit icy, as Chicago tends to be, as Avalanche tends to be. But it's hard to bet against the attitude and the energy that characterizes Avalanche. And then the last one I characterize is Near. So Near, I'd say, is more like San Francisco. So it's a little idealistic. Like Near is trying to be Ethereum 2.0, but years before Ethereum 2.0 be there. It wants to be sharded. It wants to be super developer friendly. It wants to be hyper scalable. It's very much in its first flush. It's recently launched. It doesn't have as much TVL, but it's getting there. There's a lot of growth. There's a lot of excitement. There's really, really smart people building on top of it. So it's a longer term story. It's trying to flesh out all the things that it sees in the long term future. And there's some really smart people who believe in it, and there's some people who think like it's too flowery, too idealistic for me, not my cup of tea, unless I can go gamble on something tomorrow. Yeah. So if you imagine it this way, all these different cities or these different layer ones, they each attract a different kind of user. They each attract a different kind of entrepreneur. They're built for a different type of application. There are different things that really thrive individually in these cities. But not only that, if you're an entrepreneur, it's not obvious that you want to go to Manhattan. I mean, Manhattan is a great place, but look, if you want to build, the best, let's say the best restaurant, you go to New York, you've got crazy competition. Whereas if you go to LA, you go to Chicago, or you go to Houston, actually your restaurant might end up being the best restaurant in the city. And so there's a sense in which there's a natural dispersion of companies, of startups, of applications across these different blockchains, servicing different kinds of users, but also trying to become dominant in each of their own respective cities.
Do you have a take on how attached people are going to be to these identities? Meaning if they're in, let's say, Near in San Francisco, but they realize that, Solana in LA or whatever, serves them better. Are they easily going to switch to that? Or are they going to say, you know what, I'm a Near, I've been Near, I'm Near till death? They're like, how do you think about that?
It's hard to know. I think right now, the most people who are on other chains are multi-chain, right? And so it is basically, I don't think it's I'm only on X and I won't touch anything else. I think maybe there's some Ethereum and Bitcoin maxis for whom that's true, but very few other chains have I observed that kind of behavior. I think it's more that, look, I'm open to being wherever, right? Like if you go live in, I don't know, Boise or something, you're like, look, I'm living in Boise, but like if somebody wants to give me a job in some other state, if it's good enough, I'll go. And I think that's probably also true for people on most chains that are not Ethereum. But it's possible that could change. And with enough time and with enough sort of consolidation of culture and community, I might say to look, this is my jam. This is my community. This is what people I care about, people I love. Like this is where I built up my street cred. This is where my NFT collection is. This is all the tokens I own, all the yield that I have, all the reputation I've built up on chain. And I don't want to give that up and start over. And in the early days, we're still in kind of the frontier we're still in the settlers phase of crypto, in which case, people are still mobile. They still haven't put down their roots. But eventually they will. And I think when that happens, we'll probably see less migration happening as a matter of common stance.
Yeah. Well, gearing towards closing here, maybe the last question I'll ask you is the central question we've been asking as an industry for quite some time, which is the right mental model of decentralization. You went on the Delphi podcast and you were talking with Tom Shaughnessy about it. There's the mental model of progressive decentralization that has emerged that people seem to resonate with. You mentioned earlier in this podcast that World War III proof, while great for Ethereum to have clear values, most other products probably don't need that. When you're advising projects, or like, what's your leaning or hint or even the conception of the right mental models to have or about decentralization or the ones to avoid?
I mean, in a simple sentence, you need as much decentralization as you need, and you don't need more than that. There's a common refrain in crypto that like more decentralization is better. And I think that is maybe tautologically true, but oftentimes the juice isn't worth the squeeze. There's a certain amount of decentralization you need in order to achieve certain properties. And if you go more decentralized than that, you're not really doing anything. You're mostly virtue signaling. And virtue signaling is sometimes okay. It's important to signal virtue. Like, I don't want to imply that virtue signaling is not important. That's why people do it so much, because it is really important. But you also want to be practical about, like, look, the primary thing that matters is that people use you, that people give a shit about what you're building, that you actually delight your users and you provide them some value. And if you can be decentralized while you're doing it, all the better. If you can't, okay, fine. But you need enough decentralization to be credible, to be neutral, to be legitimate, potentially to be legal. But you don't need just arbitrary amounts of decentralization just to be a good person or to not get yelled at on Twitter. I think that is a game that nobody wins in the end.
Yeah, that's a great place to wrap. My guest today has been Haseeb Qureshi of Dragonfly. Haseeb, thank you so much for coming on the podcast.
Thanks for having me, Erik.
If you're an early stage entrepreneur, we'd love to hear from you. Check us out at villageglobal.vc.